Welcome to The Tax Factor, the UK's top tax podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Rehana, Earle and Theochari.
Hello and welcome to The Tax Factor. I'm Rehana, Earle.
And I'm Theochari. This is the podcast that keeps you up to date with all the latest tax news, and we're proud to be one of the UK's top 20 business and investment podcasts.
Well, the world of tax is certainly never dull, is it, Ellie? And last week it was impossible to miss all the headlines which were dominated by stamp duty land tax. There are many opinions on whether the SDLT is fit for purpose, and we can't help but wonder whether it will play a much bigger role in the Chancellor's budget plans, which of course, as we know, now has an official date of Wednesday the 26th of November, which we're all waiting with bated breath. But before we dive into this week's discussion, Ellie, what are the top tax stories making the news right now?
The Tax Factor. Headlines.
First up, more than 200,000 people have apparently withdrawn around 18 billion from their pensions over the past year. And that's come out of a worry that future changes could reduce the amount they can pass on to their loved ones. But that obviously is out of fears growing that pensions might be dragged into inheritance tax. Alongside that, which is also a little bit doom and gloom as well, new figures show HMRC staff have taken more than 500,000 sick days in each of the past 3 years, which is about 1.6 million lost working days since 2022. As we have touched on many times in the podcast, millions of taxpayers' calls go unanswered every year, and critics are saying this is actually another blow to service levels. And as I said, we've been kind of highlighting this since the tax factor began. And finally, the cost of government borrowing has climbed to its highest level in over 25 years. So that makes it much more expensive to fund public services. And here we are again, pressure is mounting on the Chancellor to find new sources of tax revenue.
Wow. So yes, not too many positive news stories there, really. But certainly becoming quite the catchphrase for us on this podcast, finding more tax revenue. But before we get into all of that, I've got to say, and I can't quite believe it, Ellie, this is my last tax factor with you. So yes,
I know.
Have to get through today.
Oh, I'm so sad. You're losing my pod partner, and I will never replace you, Rehana.
Oh, thank you. You're absolutely right. I am irreplaceable. But let's make this a good one. So kicking into the first story. So the much reported story since the last episode was recorded is that Angela Rayner has resigned. I suspect there aren't that many people that have missed this story over the last week. But as a recap, the resignation came after Angela Rayner, who was also the housing minister and the deputy leader for Labour, referred herself to the ministerial ethics watchdog after it came to light that she had paid a standard rate of stamp duty land tax on a property that she'd purchased in Hove, so a flat that she'd bought there, and declared it was her principal private residence, when in fact she should have paid the additional 5% tax, which is levied on second properties, meaning that she'd underpaid her stamp duty land tax to the tune of about £40,000. And I think, as part of this story, there's been a lot of commentary on whether or not the tax rules are really simple enough for people to follow. And I think actually there's really mixed opinion on this, with some saying that the rules are actually quite easy to follow. And in this case, if you just done a quick Google of HMRC's website, you could have found the answer. Whereas others completely disagree, and they're calling out for more simplicity when it comes to some of these perhaps slightly funky rules and complexity. So I think with Angela going, actually, it's going to be a really interesting time to follow the perspective of tax policy, particularly under the Labour government, because in her particular case, it was all to do with the fact that the property was in a trust for her son. And quite often trusts and second homes, etc., they're all associated with the wealthy in brackets. And many people don't actually associate Angela Rayner with wealthy, being she's got a working class background and where she's sort of come from. I think with the cabinet reshuffle, the loss of Angela, who really kind of held up the left side of the party from a political standpoint, it's going to be really interesting to see where their tax policy is going to be headed.
Yeah, and it's a complex situation. And as tax advisors, we know that the UK has one of the most layered and complicated tax systems in the world. So hindsight is a beautiful thing. And when you have experts speaking in the media in lay terms that a casual observer can understand, it's very easy for people to think, oh, that must have been deliberate. But actually, it's probably just the best lesson for the public to understand the value of taking specialist tax advice and not necessarily relying solely on one opinion. It's also interesting raising the point about who qualifies as you said, quote unquote, wealthy and who can benefit from these certain kinds of tax planning, because this situation has actually now reignited another wealth tax debate from inside the Labour Party. And I know on previous podcasts, we've talked about why wealth tax doesn't necessarily work or isn't necessarily something that is seen as a positive step. So Emily Thornberry, as an example, advocated for a wealth tax. But on the positive side, it does seem like Rachel Reeves is finally seeing the light. So she has actually been quoted recently as saying, "We got rid of the non-dom tax status. We put up capital gains tax. We started treating carried interest as income, not capital gains. We introduced new taxes on private jets. We put VAT on private school fees, and we changed the reliefs on agricultural property." So then, it's a mistake to then get rid of inheritance tax and replace it with another tax when you don't know what that revenue is going to bring in.
Yeah, I mean, I completely agree. I think it's really good, or it feels like if she's made that statement, that at least we feel like the Chancellor is kind of listening to specialists who have commented on this, as well as the public, particularly, as you mentioned earlier, Ellie, with all of the complexity of our tax law and policy as it is, which has been tinkered with over the years, and it's just become more and more layered. So particularly in the case of something like a wealth tax or tinkering with these other taxes, quite often it doesn't necessarily hit the people that actually you intend it to hit. And so, it can hit the everyday earners. I think we're all kind of waiting to see what is going to happen and what is going to come about as a result of the budget in November. There's a lot of speculation, basically, and I think that will continue to go through over the next couple of months. And in fact, on the podcast that Neil and Annie did, they went through some of the kind of various changes that have been put out there as possibilities. But I think it is always quite difficult when it feels like changes are being drip fed into the media and to see exactly what the public's reaction is going to be. I think there's this continued sort of view of, what does working people mean? The Labour Party mantra has been, we're not going to increase taxes on working people. But I think we're sort of struggling to define what that actually means. Particularly, we saw the NI increases. Okay, they were employer, but they've impacted working people, they've impacted jobs, etc., etc. So if, for example, one of the changes is something like ISA, limits, etc., that could impact working people. And pensions in particular, I think, will hit every worker, regardless of their income. And some of the fear from specialists kind of working in the pensions arena and kind of financial planning space is that the speculated changes to pensions, which have been espoused as limiting the amount that can be withdrawn tax-free, perhaps restricting salary sacrifice, is actually going to cause a lot of pain in the future. So, for example, data suggests that individuals who have been withdrawing sums of money from their pensions in advance of the budget, obviously to avoid paying any tax on that, could actually leave them struggling financially in the future. I think we just have to kind of wait and see there, but hopefully there will be a balanced view on the impact and on any change to pensions. And I think it's also kind of worth noting that pensions has always been in the arena when it comes to change and raising taxes through pensions. But, we've seen previously that changes were pared back, particularly because of the impact on public sector pensions. So doctors, for example, were being really adversely impacted by changes that I think, the previous government put forward, and that was kind of reined in. And so the fact that there are ongoing disputes around public sector pay, if we then put pensions into the mix, I think the government are going to have to think really, really carefully about what they do in this space.
They will indeed. But enough about the budget, because we could talk about that and speculate.
We could talk about that till the cows come home.
Yes.
Yeah.
Some other news. The first time ever, a practicing barrister has been added to the government's list of tax avoidance promoters. This is very significant. HMRC had said that it's their view that individual who had been working for 20 years as a barrister had designed 4 tax avoidance schemes and created contract templates that are essential to how these arrangements operate. And how they operate, I had to do a bit of digging into this because naturally I don't work in the tax avoidance space. What happens is the schemes promise workers that they can keep more of their pay by avoiding income tax and national insurance contributions, but actually the arrangements never work. So those users end up facing tax bills. And then on top of that, you have your interest and your penalties and all of that kind of thing. So they're marketed really for people to pay less tax, but they pretty much never work. And then you end up paying a lot more than you originally tried to avoid. In this case, And across, apparently HMRC have found around 170 of these kind of schemes. They operate through umbrella companies. And then what happens is the workers in those umbrella company schemes are then kind of sold this scheme. So we would really suggest that anybody working in those schemes check their payslips very carefully. So some warning signs that you might see might include loans instead of wages, or really complex payment structures for what should otherwise be a pretty vanilla way of being paid. The significance of this really is that the naming and shaming of this person shows that HMRC aren't just going to target the companies and businesses that promote it, but are going to make an example of the people that are behind them, no matter what their status is, or, no matter what they're doing.
Which I think is actually exactly the right thing to do, because I think there are so many innocent people who have been caught by these schemes thinking that they will help kind of save tax, but obviously they just don't work. And it's absolutely right that the revenue are calling people out no matter what their status in the world is. So I think it's a big warning sign to anybody involved in trying to put forward some kind of scam tax avoidance scheme. But it's not just new ones, Ellie, that HMRC are looking into. And actually, I think it just shows the power of HMRC that they're going back to investigating schemes from sort of 20 odd years ago. A recent example of this is a former footballer, Craig Earle, who has just been ordered to pay in the region of £460,000 after he invested in 2 film partnership schemes, which goes back to the early 2000s. And these were actually very common. I sort of remember I did start work, sadly, back then. Didn't know a huge amount about them and certainly didn't have any money to invest in any of them. But they were definitely sort of quite common schemes for those that did have some money to put aside. Whilst this isn't my area of expertise, as I generally understand it, the way the schemes worked was that you'd first establish an LLP, and then any investors in that LLP would become partners. The partnership would then obtain the rights to the films, and then leasing the rights back to the production company who then produced the film, with the agreement that this would generate revenue for the partnership. So the acquisition of the rights is basically funded in 2 ways. The first being a capital contribution by the investors, and the second a loan taken out by the investors. And the loans would generally represent about 90% of the funding of the partnership. So the loan is then repaid by the revenue received by the partnership on behalf of the investors. And it's the loan that then creates a loss for the partnership, which can be offset against the owner's own tax liabilities, or so everyone assumed. So what many investors were unaware of was that when they were entering into the schemes, was that they would be liable for additional tax on the income of the partnership, expected to be around sort of 10 times the original capital investment, meaning that for many investors, the tax due would be far greater than the actual income. Pretty sort of complex structure, but obviously some very whizzy people that kind of came up with it. But what it shows is that revenue is certainly sort of cracking down on the fact that these schemes just do not work, and avoiding tax in this kind of way just isn't possible. Also, the fact that the revenue have got the discovery powers can extend back to 20 years. If anyone has been involved in something like this, absolutely crucial that they do seek advice to make sure that there's not going to be any adverse impact or inquiries.
Yeah, absolutely. And whilst this is a serious issue, I thought I would finish this week off with a lighter story, but it does still relate to HMRC discovery assessments. So you may have heard of the age-old excuse of my dog ate my homework, but this week a bus driver lost a £28,000 appeal against HMRC as he had no evidence of expenses, as rodents had eaten all of his receipts. The driver being investigated had claimed that he had had to spend quite a lot of money on PPE during the pandemic, and alongside that, some accommodation for himself and his family, and also some specialist equipment that he thought was necessary for him to carry out his job after he'd had a traffic accident in 2016. These were kind of quite basic things like masks, antiviral products, PPE, all that kind of thing. The problem was that there weren't any receipts for any of this expenditure, and he wasn't able to prove that any of the items listed were even bought. So HMRC had approached his employer, well, his previous employer at the time, and said, did he actually spend any of this money, or did he need any of this? And they had confirmed that actually they had provided everything that he could possibly need to carry out his job, regardless of COVID, and that they had no recollection of some of these items being seen. So HMRC didn't actually believe that any of these items were necessary to carry out his role as a bus driver, or that he'd ever even bought them.
The lengths that people will go to, Ellie. We'll have to wait and see what the next one is.
Blick Rothenberg, celebrating 80 years.
That's about all we've got time for this week, though. So many thanks to the brilliant Ellie for joining me on my very last Tax Factor.
Next week, Mally Kinney will be back along with a new voice. There's a theme to this season. Tom in 1 week, Annie last week, and next week will be Stephanie Tremaine.
So lots of luck to Stephanie for her first Tax Factor next week. If there is a topic you'd like us to cover on future episodes, you can visit the Tax Factor page on our website where you'll find a form to contact us. We'd love to hear from you, but we can't answer every individual tax query on the podcast. I'm Rehana Earle. Thank you for listening, and we hope you enjoyed the episode.
Goodbye.
That's the Tax Factor. Since launching in August 2023, we've become the UK's top tax podcast in the UK podcast chart. Join us every Friday for expert insight on the latest tax news. Subscribe on your preferred podcast platform or listen direct on the Blick Rothenberg website, where you can also find the latest updates and analysis. The Tax Factor from Blick Rothenberg. Copyright 2025.